Ladies and gentlemen, good day and welcome to the Q2 FY2024 conference call of Happiest Minds Technologies Limited by ICICI Securities. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sumit Jain from ICICI Securities. Thank you, and over to you, Mr. Jain.
Thank you, operator. Good morning, ladies and gentlemen. Thanks for joining us today on Q2 FY2024 earnings call of Happiest Minds Technologies Limited. On behalf of ICICI Securities, I would like to thank the management of Happiest Minds for giving us the opportunity to host this earnings call. Today we have with us from Happiest Minds, Ashok Soota, Chairman, Mr. Joseph Anantharaju, Executive Vice Chairman and CEO, Product Services, Mr. Venkatraman Narayanan, Managing Director and CFO, Mr. Rajesh Shah, President and CEO, Digital Business Services, Mr. Ram Mohan, President and CEO, Management and Security Services, Mr. Aurobindo Nanda, President Operations and CEO, Product Engineering Services, Mr. Sridhar Mantha, CEO, and Mr. Sunil Gujjar, of Investor Relations. With that, I will hand it over to Sunil for the statement and take the proceedings forward. Thanks, and over to you, Sunil.
Thank you, Sumit. Good morning to all participants in the call. Welcome to this conference call to discuss the financial results for the second quarter ended September 30th, 2023. I'm Sunil, Head of Investor Relations. You can review our financial statements, quarterly fact sheet and press release which are uploaded on our website. Agenda for this call is as follows. Ashok will begin the call by sharing his perspectives on the demand, business environment and our results. Venkat, Joseph and Rajiv will speak about our financial performance and operational highlights, after which we'll have the floor open for Q&A. Before I hand over, let's begin with the safe harbor statement. In the call, we could make forward-looking statements. These statements consider the environment we see as of today and carry a risk in terms of uncertainty, because of which our actual results could be different. We do not undertake to update those statements periodically. Now, let me pass it on to Ashok.
Thank you, Sunil. A very good morning to all the participants in the call. I am happy to share with you that Happiest Minds has continued to deliver industry-leading performance, growing 3.6% sequentially in constant currency. On a revenue growth plus EBITDA, we were at 38.9% with another quarter of superior performance. Our EBITDA margin at 24.5% has been well above our guided range of 22 to 24%, and this is now for the 13th quarter in a row. We crossed two significant milestones during the quarter. We completed 12 years as a company, and we completed 3 years as a public entity. I would congratulate all stakeholders who have contributed to and been a part of this journey and express my gratitude for your continuous support. During the quarter, we raised capital through a QIP, and I also sold a small portion of my equity at Happiest Minds. Both these events led to a small dilution of my equity interests. The latter was primarily done to fund the capital requirements of SCAN, a not-for-profit medical research entity that I started, and also to enhance the capital structure of Happiest Health. This capital infusion for these two entities should take their requirements, their capital requirements for the medium term. As part of my commitment, I believe to have Happiest Minds system, my controlling interest in Happiest Minds will not be allowed to go below 40%. I should also clarify that my current shareholding percent of 51.3% is safely well above this threshold. While many companies in our industry are seeing a declining headcount numbers, we in the quarter have added 237 Happiest Minds to our teams. aligned with our commitment to work and execute our larger vision to a billion-dollar enterprise in sales by FY21. In quarter one, we had given a revenue growth guidance of 25% without making a distinction between organic and inorganic growth. Based on an assessment of the market dynamics, we are revising this growth guidance for the year 12% on an organic basis. Additional growth, if any, due to acquisition, will be over and above this guidance. We retain our EBITDA guidance of 22 to 24%. I am now happy to announce major new organizational and strategic initiatives at Minds. In order to avail of the transformational opportunity being presented to the entire industry, I would say, to every industry through generative AI, we are creating a new business unit called Generative AI Business Unit, which will be abbreviated as GBS. This will become a new engine of growth, and it will require a lot of collaboration because the sales will take place through the entire organization and through every industry group. Accordingly, we have selected Sridhar Mantha as the President and CEO of GPS. Sridhar is a Happiest Minds stalwart since inception and best person to lead this in view of the interactions and collaboration are required. Sridhar will be, the initiative will be led by Rajiv Shah as a member of the executive board. While we're doing this, we're also integrating our existing PS and DBS businesses into one combined business called DBES, and this will be under Joseph Anantharaju, who has been our most successful business unit up till now. There will be no change in IMS. Therefore, we will retain our three BUs, EDES, IMSS, and now the one will become GPS. We believe these three engines of growth take us forward to our future goals. We want to emphasize again, though, that since it will take time to build up the whole organization in GPS, there will be no meaningful revenue until the beginning of the next financial year. Accordingly, we will only start reporting the numbers once the new year begins as part of a plan we will go out. Let me conclude my commentary by wishing all on this call a very happy Navratri, and with this, over to you. Thank you.
Thank you, Ashok. A very good morning to all of you on the call. Wishing you and family a very happy Navratri. The next few minutes, I will take you all through the financial performance and certain key operational highlights for the quarter and the half year that ended September 30th. For a start, amidst all that's happening in the world, I'm very grateful for the place we are in. Coming to the financials, very happy to share that our total income for the quarter for the first time has crossed the 50 million mark. Total income for the half year, the same time, has crossed the 100 million mark. Now coming back to the quarter, operating revenues at 49 million grew sequentially by about 3.3% in dollar terms and about 10.8% year over year. While in constant currency, this growth was 3.6% and 11.6% respectively. Clearly, our results demonstrate our ability to do what is right for our customers and stay relevant and agile to their needs. Total income for the quarter was 429 crores, showing a sequential growth of 6% and 19.3% year over year. EBITDA margins for the quarter stands at 24.4 compared to 25.5 in the previous quarter. The 100 basis impact was mainly due to wage hike that was rolled out to a major part of our people effective July 1st of this year. It's important to note that we continue to beat our margin guidance of 22 to 24% in spite of above industry pay increases, payment of variable pay, and net additions in people. All areas where we have seen divergent approaches taken by other industry participants. After taking the increases as said, our EBITDA for the quarter stands at 105 crores, showing a sequential and year-over-year growth of 1.8% and 11.1% respectively. Profit before tax was 79 crores, 18.5% of revenues, and showing a growth of 0.6% sequentially. Marginal decline of 1.2% on a year-over-year basis was primarily due to the amortization of intangibles that came about from the acquisition of SMI that we did in December of last year. We are taking a quarterly hit of about 7.5 crores on this count. Profit after tax was 58 crores, which is 13.6% of revenues. Now switching to our numbers for the half year, like I said, our total income for the first half of the year crossed 100 million. Operating revenues grew 11.7% to $97 million, while in constant currency, the growth was 12.7% half year over half year. Total income stood at 833 crores, which was a growth of 21%. We continue to demonstrate good cash flow conversion with almost 98% of our EBITDA coming in as free cash flows. We ended the quarter with about 1,300 crores of cash and cash equivalents, which includes the 500 crores that we raised through QIP and the 35 crores that we raised through issue of listed NCDs. I'm grateful to all market participants for their continued support to the company. Talking about a few operational highlights, at the end of the reported period, we are 5,285 Happiest Minds, a good addition of 237 over the previous quarter, which include joiners from campus. Our utilization has improved from 74.5% in the previous quarter to 76%. Attrition levels on a trailing 12-month basis have trended nicely and now at about 14.4% compared to the 16.6% in the previous quarter, and a significant reduction from the 23.5% we saw a year back. As expected, our return on capital employed has dropped to 23% from the 33% in the previous quarter, primarily on account of the capital raise that I talked about earlier. It will be our endeavor, and this our endeavor to improve this return ratio by deploying capital into growth avenues like the new BU that we are creating, Ashok talked about earlier, and establishing and also through acquisitions. I request all of you to go through the investor deck on our website, which has much more details and operational highlights. Finally, in line with our progressive dividend policy, the board of directors of the company have recommended an interim dividend of ₹2.50 per equity share. Record date for this payout has been fixed as October 30th. Cash outflows on this count will be about 38 crores. With this, I conclude my commentary, and over to you, Joseph.
Thanks, Venkat. Very good morning to all the participants in the call. We have yet again delivered industry-leading growth in the second quarter, which reflects continued customers in our value proposition. During the reported quarter, we acquired 10 new logos, many of them being large Fortune 500 enterprises. Continued ability to open doors across large high-tech companies, energy conglomerates and retailers emphasizes our value proposition. We continue to execute on a land and expand strategy as reflected by the consistent increase in the average revenue per customer, which is at $804,000. We were also able to increase the number of large customers, as evidenced in an increase of our $10 million and $5 million customer cohort during the quarter. Now, I would like to share a sense of the conversations we are having with some of our customers. I'm delighted to share that the leading global online retailer and hyperscaler chose Happiest Minds as the engineering partner to design interactive user interfaces and to provide automation services for their IoT platform based on our IoT cloud automation and product engineering DNA. With our mindful 4D framework, which is explore, envision, engineer, and enhance, we have been assisting companies in their innovation and digital transformation journey. For a multi-billion-dollar enterprise, the energy distribution sector, we leverage this framework to transform their document management systems for automated retention, intelligent search, and faster retrieval, thereby improving customer experience. Our comprehensive and integrated suite of solutions are helping our customers secure their distributed IT environment 24/7. During the quarter, a leading warehouse operator in the United States chose us to provide security assessment services on threat modeling and application security. Companies are reinventing every part of the enterprise using technologies, data, and AI to optimize operations and accelerate growth. For a large US-based utilities company, we have been chosen as a key partner by data engineering and governance services. We're working closely with alliance partners to deliver the benefits of digital technologies. And in one of a common customer, we are helping an industrial internet platform provider to build a data platform for their farm-to-table process using our deep IoT data and AI capabilities. Speaking a little bit about the demand environment, multi-year digital transformation initiatives are being broken down into shorter composable engagements. That's what we've seen. This creates the right kind of opportunities for a company like Happiest Minds to exhibit agility, create value faster, and gradually expand into other related areas. However, in the face of macro and geopolitical uncertainties, customers are getting more prudent and seeking more time for back and taking longer to take decisions. To accommodate this shift in threats and uncertainty, they have decided to revisit the guidance as alluded by Ashok earlier. With the creation of the GenAI BU, I'm happy to share that we are merging S and DBS business units into one and digital services business unit as a first step in our strategy to verticalize and better leverage synergies and capabilities as part of our $1 billion goal by 2031. I'm excited given the responsibility to integrated unit and our learning customers that focus on white spaces and land expand strategy to the next level. With this, I would like to end my commentary wishing you all of you a happy Dasara, and I will now hand over to my colleague Rajiv.
Thanks, Joseph. I'm excited to guide this new function of GPS and work with a fantastic team led by Sridhar Manta, President and CEO of GPS. At Happiest Minds, we are known to take technology bets well ahead of time. Take, for example, IoT, which started building capabilities well ahead of time around 2015 before it became a mainstream area of investment for the customers. Been working since 2018 on the earlier form of Gen AI as part of our AI focus. With a strong base of AI and analytics technology, the dedicated focus on Gen AI will open up significant opportunities for Happiest Minds. Over the next few months, we will define processes, timelines to ensure that all of our 5,000 plus Happiest Minds get exposed to the practical application of Gen AI in their line of work. The target is training on Gen AI and develop teams to engineer business solutions. And outreach to our existing customers to showcase our prowess in place. We're already working with 20 plus customers in the Gen AI area. We want to strengthen and forge new partnerships in the alliance ecosystem, including working with Microsoft, OpenAI, Google, AWS, etc., and other source platforms as well. A broader go-to-market strategy to the addressable market with our value proposition. Start tracking the financial parameters of GPS going forward, and we'll be starting announcing them for the next financial year as highlighted by Ashok. To conclude, we foresee that generative AI can be a significant revenue source for us in the years ahead and help us reach our vision of becoming a billion-dollar enterprise by 2031. With this, I end my commentary. Now open the floor for Q&A.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask questions may please press star and one on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and two. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We'll take the first question from the line of Ashish Dash from Mirae Asset Capital. Please go ahead.
Hi. Thank you for the opportunity. So my question is on the guidance. So you have got in organic revenue growth guidance. I wanted to know what happened during the quarter so that what is guidance from 25% to 12%. And also you mentioned last quarter that there is a recovery in the demand. You are expecting a recovery in demand in 2H. What is your view of that right now? Yeah.
Venkat, shall I just address the point on overall on the guidance? And then I guess really all the people can talk about they see about demand vis-a-vis any other statements we may have made. And so you're right in one sense that we've never differentiated in the past between organic and inorganic growth. We were certainly expecting, even as we began the year, to get almost a whole year of a very large acquisition getting reflected in our results. Therefore, the numbers that we had predicted clearly not out of line to the extent that this particular guidance will indicate. On the other hand, we also know that getting an acquisition through is sometimes a bit of a uncertainty. You really don't know whether the deal will go through or not. The deal talking out actually it has not gone off the table even now. And yet we don't expect even, assuming we even here, we don't think we get any revenue out of that. That is a major dramatic increase. I don't think it's a difference in this guidance. Overall, there's no question that markets have had clients. You see this in the results of all the entities who have been sharing the results, and in that respect, I'd say our result continues to be based on industry-leading performance. Some of the issues of in terms of this as well as demand outlook, I think my colleagues will pick up for you, and I think it's really best if each of the three business units give their response to this particular point that you raised. I do want to add that we do need seeing a further trust to grow. And that is one of the reasons why we have created this Gen AI business unit. It's a major change. We believe nobody's taken a change of this sort towards addressing this opportunity. It won't yield results overnight, but in the long run, it will certainly play a very, not only medium and long run, it will play a very important role in terms of taking us on to our declared vision of achieving $1 billion by 2031. So this passes over to Joseph, Ram, and lastly Rajiv, because he can then also talk about the new business area.
Ashok. And before I talk about the overall demand environment, I just want to sort of give a little bit of context on Q3. All of us have to be cognizant that Q3 has a lower number of working days, which is around 3 days lesser than the other quarters because of Dasara, Diwali, and Christmas holidays. We're trying to work our way through that. So I just want to put that as a context. So if you look at the broader demand environment, I see customers having enough needs and initiatives that they need to get done to digitize their processes, their offerings, and really impact the customer. So that's at a group level, as I think that demand is there. What we also are seeing is that given some of the macroeconomic, I would say a little bit of uncertainty, at repeated intervals, some geopolitical developments, there's also a little bit of that, let's take a look at what's going to happen, and instead of having large initiatives that they would typically have started, they're looking at doing things in multiple smaller packages. And this, as I mentioned earlier, works out to Happiest Minds' advantage because we're not looking for $20, $100 million kind of engagements. We're looking at engagements that go and work closely with customers, validate some of their assumptions, doing POCs, pilots, and then take it to implementation. And while it elongates the sales cycle a little bit, it actually works to our advantage of a company that's more agile, that's nimble, and more of a partner than a vendor. And that's what we are seeing in terms of demand.
This is Ram. As Joseph mentioned, there will be, holiday season and number of days in quarter 3, but there's also a period where a lot of budgets are going to be finalized for the subsequent year, and we believe that the beginning of next year will be much more better. That is something which we are seeing in the market. Apart from that, what I'm really excited is about our integration of PES and GPS business, which actually makes the IMSS to become a horizontal across all the verticals, and thereby enhancing our land and expand strategy. Also the GPS business, which will also bring a lot of generative AI capabilities in the IMSS space as well, whether it is in terms of service automation or in terms of security and infra operations, where Gen AI can be very easily distributed to provide better solutions for our customers. And that is what customers are also looking at. So looking ahead, the integration of PES and GPS and also GBS, I believe that there will be much better opportunities for us to land and expand in our existing customers and go after new business. Over to you, Rajiv.
Thank you, Tisha. So, just adding to what Joseph Ram said, yes, there is some sort of uncertainty continues to happen, and increase the pressure on the macroeconomic environment. But I think the kind of work that we perform for our customers and the value that we deliver, we continue to see a level of traction. They stand up continuous cost pressures. They still want to take the advantage of the newer technologies, OpenAI, ChatGPT, native AI, etc. And our platform of integration of low-code, data, AI, etc., I think we are in the right space for us to really create value for our customers. At the same time, you have larger integration opportunities as well. As customers are looking at optimizing their own environment, monetize their own set of investments, we continue to see more and more integration opportunities. So from that perspective, I think that the reason we set up the Gen AI unit is to really work with the customer, really help them drive how to set up their own organization, how to increase consumption in their own environment. At the same time, optimize their own environment to become more efficient and effective as well. So yes, there is pressure. There are disruptions that are affecting all of us. But fortunately, there is no cancellation of contracts or no real price pressures that we have undergone. But at the same time, the opportunities are there as well.
So one follow-up question on that. So you are saying there is no cancellations and no pricing pressure. So are we thinking that inorganic contribution would have been more than 10%, but it got delayed, so that contribution is not coming? And that is the reason, or do you see that also you put down your own guidance to 10%? Just wanted to know your view.
Yeah. Venkat, again, I'll take it, and maybe this time you may want to add a little bit. So the first really important thing is to say that actually there is never any distinction in our guidance between organic and inorganic. We ourselves internally say so much will be organic, so much will be inorganic. And largely because you have to visualize that when a company of our size is planning even a decent acquisition, let's assume it's a company with $50 million. That's going to impact us in a very significant way. But if it's a multi-billion-dollar company, even if it's $100 million as an acquisition, it don't need to make the distinction. They get a $100 million account, or they make the acquisition. Either way, it will become a part of their growth story. Whereas in our case, it's a very distinct difference. It has to make a distinct difference. And, it's another matter. In the previous years, we managed to reach the guidance number in spite of the fact that we have very little acquisition. Negligible, I would say. Here, obviously, while we were hoping for one, it isn't that we made the distinction even this year. It's difficult for me to say that because we had planned to say X%, but now we reached 12, that's a reduction. That is not the case. It was a composite total, and that is why we are now giving you a non-composite total, because we know the acquisition element is not going through. And therefore, we're giving you the number reflecting the balance of the market. Venkat, you want to add anything?
Ashok, I'm not able to hear Ashish very clearly, so that's why I've not been able to.
You are. Were you able to hear me clearly?
There is a little bit of static when you speak as well, but I understand this is about the guidance. And
yeah, but if you want to hear it clearly, go ahead and explain. So I believe maybe we can ask Ashish whether he got what he needed from my response.
I got your response. Just a last question from my side. Do you still pursue acquisition planning during 2H, which got delayed?
Now you have to repeat the question. Even I've not heard it clearly. Say that again.
Static on the line, I guess.
Yes. Hear me? Is it better now?
I can hear you. Yeah, very clearly now.
Mr. Dash, I would request you to kindly use your hands, sir. Because when you use your headphones, there is a lot of static on the line.
Okay. Is it better now?
Yeah, much better.
Yes.
Much better.
My question is, do you still pursue the acquisition plan during 2H?
Yeah. So, very clearly, I mentioned that in the very beginning. We clearly had an expectation of a very large acquisition. And I also mentioned that knocked on opportunity. But we don't expect anyway, if you're considering the stage we are in now, if we've not signed, let's say, at least a letter of intent to done due diligence, we won't get any revenue into this year. Maybe in a smaller entity, we may get a small bit of revenue, which is why we said additional revenue from acquisition, if any, will be about the 12%. But the larger one, if it's signed during this year, will yield revenue only in the next year. But it's not done off today, but that is the good news. And hopefully it comes through.
Okay, thank you so much.
Thank you. A reminder to the participants, anyone who wishes to ask questions, may please press star and 1. We'll take the next question from the line of Sumit Jain from ICICI Securities. Please go ahead.
Yeah, hi. Thanks for the opportunity. The probe on your guidance. So actually, I mean, if I look at your 12% organic growth guidance for FY24, that does imply a CQGR of around 5-6% for the second half of FY24. So to understand, what gives you confidence of a sharp revival in growth second half, given the overall environment from the discretionary spend perspective?
What do you want to handle this?
Yes, I just joined again because
Did you hear the question from Sumit?
No, I didn't hear.
Sumit, please repeat it for them.
Yeah. So, I mean, I just want to understand your guidance of 12% organic growth in FY24. That imply close to 6% CQGR for second half of FY24, which is obviously a sharp revival of growth, what you are assuming. I want to understand, what is giving you that confidence? Is it the current order book, certain top clients, increase their spend? I just want to understand what is giving you confidence.
Yeah. So the first half of the year, we have done 12.7% in constant currency. That's half year over half year. So we are hoping to continue a similar trend of growth for the next 2 quarters. And so you get the 12% for the year. So I didn't look at the CQGR, but if you look at it, you have to continue what you're doing right now for the next 2 quarters. This is essentially coming from, repeat client business that we're getting. We pick up in business from the new logos that we've signed up. 7 logos this quarter, 13 the previous quarter, and 14 the quarter before. So it's been a strong sign-up that's happened. It's been taking a little while than what you would have expected maybe a year and a half back on the ramp up. So those aspects have been considered. And most importantly, the 2 less working days this quarter. So we have to really, take some alternate steps on that, making us effectively working. We're working with the project teams to make sure that we're able to make up for those lost days, because a day is close to $700,000 in revenue. So we have assumed all of those and a repeat of the first 2 quarters, reasonable repeat of the first 2 quarters, and that's how the number of 12 comes from.
So in summary, that actually we're not seeing any major increase in the quarterly growth in the second half of the year. We're literally saying if we did what in the first half, at least then we will achieve this number. And there's no reason to believe that we will not be able to do that. Because that's still a guidance.
Got it. So secondly, want to understand, you guys obviously are sitting on a certain amount of cash from the QIP. So what kind of M&A candidates are you currently evaluating in terms of capabilities or structure?
Maybe I think we could really Joseph to talk about the angle of types of capabilities. And then if you, because we do know the size is a reflection of the fact that we raise cash to do a big one. But maybe Joseph, you could talk about that which you're interested in. And it will be so many of them.
Yeah. So, there are multiple, angles that we're looking at when we're evaluating or even shortlisting our acquisition candidates. The first one is looking at from a domain angle, looking at where and what we can get companies that would fill in white spaces that we have from a subsegment standpoint, right? If you take, let's say, BFSI, in BFSI there's insurance, reinsurance, crop insurance, and multiple kinds of things. We've identified a few white spaces in terms of our subsegments or subdomains where we would like to strengthen our capabilities. So that's one, huge angle that we are using. The second one is, again, from a technology standpoint, there are white spaces, whether it's in, some of the low-code platforms, some of the data and AI platforms and products that we are partnering with, we would like to have more skills and more customers and revenue. So that's the other one, the technology part of it. We're also looking at it from how it can get us into some of the named accounts or large customers we have as a target. And if you look at the SM acquisition that we made, it's to a customer that we had been targeting for some time, that got us into the healthcare space, where they had where the largest vendors for a long period of time, and hence understood the customer environment. So that was the other, that's the third angle that we're looking at, where it gets us to a short list of customers we want to break into. That can also map to the first two parameters that I talked about. And the fourth, which is which is a good to have, is more about does it give us capabilities or market presence in a new area that we've not or the viewers we've not been in. But having said all of that, I think the common parameter criteria that we use to ensure that whichever company that we are considering, there's a cultural fit, so that from an integration standpoint, we don't run into challenges.
Sure. And if I can add, Sumit, I think it's equally important sometimes in an acquisition to be careful what we will not do. So one thing we are not going to go and do is to do anything which takes us away from our 100% digital positioning, or 100% digital business. Second is just for the size of scale. Third, though we will look at areas in AI, which is important, we're not going to look at saying, hey, the latest area is now Gen AI, let's acquire that capability. We believe we will build that capability. We're going to build an organization, and we are already doing that to build that capability. This will be down to go out and try and leverage on what others are doing. This has done very closely linked to the nature of our business and add to each one of our industry groups. So that's something we will build ourselves. And that can add to it the areas that Joseph said we will do.
Got it. That's cool. Just last question for Ram. I can see your infra management security services business line has been now flat for the last 6 quarters. So can you explain the reasons for the weakness, and when can you see the ramp up happening in this service line?
Yeah. Actually, what had happened was one of our large customers had some difficulty in their business, which reduced some of the revenues for us. But on the other hand, we have been growing and making up for all those revenue reduction which happened. So that's the reason why you are seeing flat. And I told you before, we are seeing a positive growth in this particular as well in the future. So we are hopeful that, we will be able to continue our growth starting, Q4 of this year. And we are also seeing an increased demand security area, which also we believe that we will be in a position to make up for all these issues which we had with respect to growth starting Q4 of this year.
It's a very valid observation, and I'm sure now Ram is coming into it from a period of confidence, because it has been a stress, the fact that we've had this well-observed statement of yours that yes, there's been a softness for several quarters in a row. But it takes time sometimes to revive from that, and you've had no real reason. It's a reflection of the customer's own business. Our business is a steady, robust business and is now beginning to get back into giving us the sort of business we were used to getting from that. Plus, of course, exploring many new opportunities, which have taken time to build up. Would it be right to say, Ram, we've signed a few contracts which we hope will go? Because it takes time for an account to go, and it's those new accounts which will then make up for providing growth even while the account which went down still takes a quarter or two to revive.
Yeah. The new deals which we have signed up, though we have started small, tendency to these accounts because the services have been good, and also our customers are seeing the growth happening in their segments as well. So the new deals which we have closed in the last couple of weeks, we believe that is going to grow in the next couple of quarters. It will start seeing growth. That is the reason we are confident that we will be able to grow as usual in the past, starting quarter 4 of this year.
Got it. Thanks for my questions. I will come back in the queue.
Thank you. Before we take the next question, I request to all the participants to please pick up your handset while asking a question. This is required to ensure optimum audio quality on the call. Thank you. We'll take the next question from the line of Dipesh from MK Global. Please go ahead.
Yeah, thanks for the opportunity. Just one clarification. SMI acquisition we consider as part of organic revenue growth guidance, or it will be additional? Because last year it did for a quarter. Just to get clarity. And second thing is about the M&A. We are pursuing M&A for some time. No major progress so far. So what explains in terms of whether the valuation mismatch is driving some kind of getting closer, or in terms of the targets are becoming affecting overall macro uncertainty? If you can provide some reason which explain delay in some of the deal figures.
So I just Venkat and Joseph, both of you could respond to that.
So we closed SMI last quarter and last quarter of last year, adding in about $2.5 million, $0.4 million into revenues. Obviously, build a sort of corpus of the acquisitions that we're talking about. This is the interim place where we are raising money through capital and through a little bit of debt, which will then be deployed on acquiring companies where the return on capital will be more than 50%. So if your cost of funds is about 7.5%, you pay, you are able to generate 22-23% on the capital that you employ in an acquisition, or for that matter into your existing business or to a new business. That will generate, the alpha return that we talk about on the company. That's the reason. The drop for profitability year over year, if I should say, is because we have taken close to 8 to 9 crores intangible write-off this year, because we had acquisitions. We follow quite an aggressive way of accounting for the split of the purchase consideration. We have acquired SMI and before that PGS, and there is a significant part of that purchase consideration which goes and sits in our intangible. You don't put all of it in goodwill. So there is an assessment which is done. Based on that, it goes into your intangible, and the intangible is then written off over 5 years. We don't carry it. If you really look at that number, you should compare it to the cash flow that we talk about. So 58% of your EBITDA going back to cash has to be seen in line with that. So there are leverages that are there in your financials. Second is, year over year, on the EBITDA front, we have taken a drop. No way. There's no place about it. Primarily because we have divergent. Like I said, unlike other companies, we have met our commitment to the joiners. We are making investments into the business in terms of people. We are giving pay increases. So if you have seen our competitors or comparators, industry participants, other industry participants, as I like to call it, they've all deferred their pay increase. They're talking about headcount reduction. Compare that to what we are doing. We are increasing our headcount.
I don't think we should say that all have deferred pay. Some have done and some have been lower.
Some of them, Some of them have deferred payouts. Some of them have made differences in how they do their, variable pay payout and how we take them. So there are divergent approaches being taken with intention to, manage the cost. Whereas we, keeping in line with what we see as we've been saying, building that $1 billion company, the platform is being built with investments being made into the company. And it was with that in mind, we had always made this guidance of 22 to 24%. While we were reaching 25, 26%, it would not have taken much to say, hey, we are upping our guidance to 25%. But we always mentioned that we would not sacrifice future growth possibilities by not making the investment that is needed today. So you have to see all of this in conjunction, and you will get that will give you a better fit of the company that we're trying to build, an organization that we are trying to build.
Sir, the participants have left the queue. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to Mr. Sunil Gujjar for closing comments. Over to you, sir.
Yeah. Thank you for joining us today. We thank Happiest for hosting this call on our behalf. We look forward to interacting with you. You can reach out to us at ir@happiestminds.com. Thank you.
Thank you. Thank you, sir. Thank you, members of the management. Ladies and gentlemen, thank you.
Bye-bye.
Thank you.
Thank you. Bye.
Ladies and gentlemen, on behalf of ICICI Securities, that concludes this conference call. We thank you for joining us, and you may now disconnect your lines. Thank you.